That takes us to our talk of the tape. What do you do with this little flutter in the tape, and where does it leave the soft landing trade? Let's bring in Lauren Goodwin of New York Life Investments, Keith Lerner of Truist Wealth, and Peter Cecchini of Axonic Capital to talk about that. Lauren, so many things going on in the last week. It's actually refreshing. We have a lot of these kind of storylines that are changing. Soft landing trade on top of we can see our way to a Fed rate cut trade on top of a maybe Trump trade, all pushing in a similar direction. Has it caused you to sort of rethink where you'd want to be positioned?
Only on a tactical basis. This is a market, a Fed pivot market, 2-3 months before we expect a cut, exactly as we'd expect to see it. A lot of uplift in areas like small caps, other areas of the risk market where capital's really unlocking. But the reality for the market is that we've already been in a soft landing for the next 9 months. And so as we look to why the Fed is cutting rates and the market starts to catch up with that reality, might be a couple months from now, but we expect that the economy is still liable to slow. So portfolio balance is really the name of the game here. And we can talk about politics all day, but of course that layer is important as well.
When you say the why the Fed might be cutting is significant, you suggest that it's in response to slowdown fears or a slowdown underway, as opposed to just, hey, inflation's back toward our zone and it's time to be less restrictive.
Right now, it's the latter.
Yeah.
It's the data is really not reflecting a stressful amount of slowdown. And that's why I expect that in the next couple of months, we will continue to see improvement in risk assets overall in breadth of areas like small caps. It's a risk on rally. But that's what happens only when the Fed is cutting at a moderate pace. If we do start to see the labor market deteriorate, which I expect will happen as we get towards the end of the year, that's when you would start to see the market reacting to, oh no, the Fed's cutting, bad news is bad news, as opposed to what I expect to be more constructive in the near term.
Keith, what's your read on just, I guess, the tactical rebalancing of this market that's happened in such a dramatic way? Obviously, the scene was set by just exactly how narrow and crowded the top of this market was for so long, and we've got this snapback effect. But where does that leave us right now?
Yeah, well, first, great to be with you, Mike. It's been an interesting period. We downgraded tech at the end of June because we had the best relative performance relative to the S&P on a one-month basis since 2002. And then, as you mentioned, we had a condition heading into last week. That means the most oversold condition for small caps and the average stock we've seen in about 20 years. And the spark, as we all know, is that light CPI report. So I think where we are today is I still think this kind of rotation to small caps, the equal weight, has further to go. The rubber band was stretched so far that even right now, if you look at where we are, small caps are still trailing by a wide margin. Small caps are actually still below where they were at the end of 2021. So I think it has longer to go because of position. And I also know we're going into more of a seasonal weak period for things like semiconductors and tech. But I think more broadly, the market will start to chop around at the headline level, and we're going to expect to see more of this as we move into the back half of July and into August. Ultimately, we still think this market has legs. We think the bull market's intact, and ultimately, we think that the money will rotate back into tech later this year. But at this point, I think investors have to be somewhat patient on that trade.
Yeah, Peter, it's a pretty decent reminder today that, the market doesn't necessarily owe you a place to hide and absolute returns on a short-term basis. If one thing is not working, it doesn't mean everything else offsets it and works. But what's your read on not just what's driving it, but whether it was more than just mechanical and what the fundamental message might be?
Yeah, there's really a place to hide, Mike. I agree with you on that. I agree with Lauren, and this is a pretty typical market action into what the market initially expects to be an infallible Fed that can manage the economy into a soft landing. The market will typically trade up across the board. There are obviously some differences this time around given the AI narrative, but typically rallies into the first cut, and then as the read-through is that the economy is slowing, and that's actually the reason for the disinflation, as opposed to a Goldilocks scenario where you have disinflation and optimal growth relative to inflation. The market sells off. So typically when the Fed is deep into its rate cutting cycle, markets tend to sell off. I don't think we're there yet. I do think it's 3 to 6 months away. And our view is that into the end of the year, the Fed is gonna cut pretty hard. I would also say that this massive rotation into small caps, with small caps up 10 to 12% in 4 days, is also a result of the fact of what Keith said, which is that small caps have been sideways for quite some time. S&P volatility has not been realizing, meaning that anyone who has tried to use the S&P as a hedge has lost a lot of money. And so people were tending to use the Russell as a hedge proxy, especially for credit portfolios. And as a result, a lot of people were wrong way positioned. And when the Russell started to rally on retail participation, which has been massive on a historical basis, a lot of people got squeezed in the Russell. And I think that's really primarily what's responsible for the rally.